Hi, this is Jim Jacobson. I'm a Senior Vice President and Wealth Advisor with Girard, and with us today is Tim Chubb, our Chief Investment Officer. Thank you for joining. Today we're going to cover three topics. The first one being the current trade escalations with China. The second one being this topic we hear about sell in May and go away. And the third one being an update on IPOs. So with that, let's talk about the trade tensions. Tim, we've had a ratcheting up the last couple of weeks here. What's currently happening and what's on the forecast of the horizon?
Yeah, it's been a resurgence of the trade talks 2.0. In the last couple of weeks, we've seen some news come out of Washington related to Huawei, one of the largest telecom and media company in China, and their lack of access to some of the suppliers that they use within the United States with regard to, in particular, semiconductors or chip stocks. And so when that was announced, we saw chip stocks really take a dive. A lot of the NASDAQ and just overall growth in technology companies as a whole, really businesses that have a lot of exposure from a revenue perspective to China. And then it was announced that the U.S. would allow Huawei to continue buying these chips to continue keeping their business as going concern as opposed to indefinitely. So I think the view was a lot of these companies would see kind of a one-time inventory build from Huawei, but overall this was a major piece of news and likely leverage for the U.S. Negotiation. So.
Interesting. So as we look forward then, we've had this escalation, China's kicked back a little bit. What do we see as a long-term and short-term result of all of this?
I think the short term is just a lot of volatility. I think long term, the trade war is something that can lengthen or shorten the economic cycle. If the trade war has permanence, I'm truly concerned about that because I think both economies need one another to function and grow. And I think that's an unlikely result. But overall, I think we would see the stock market react pretty positively to the news that a trade war has been agreed upon.
You mentioned some of the chip stocks. So Intel, big company. Are there some small companies that are affected?
Yeah, small cap stocks have been impacted as well. Although a lot of their revenue isn't coming from the United States, or is mostly coming from the United States. I think the concern is that small cap companies are not going to be able to lobby, with the U.S. administration to come on the exempt list. Like a lot of larger businesses have. So they've sold off and are basically in correction territory. But I think, again, if we do have some resolution with the trade talks, they would be ones that most definitely benefit from it.
And that would be an interesting rebound then. So perhaps the long-term implications are some opportunities out of this.
For sure. Yeah, I think there's been an opportunity to buy the dip. Of course, if in the case of the trade war doesn't rear its ugly head and escalate further. With the warm spring weather, now's the time where the media likes to talk about selling in May and going away. It's an old phrase that suggests that investors should take profits in May and get out of the market for the course of the summer, getting back in October when the volatility is likely over. But what does the historical context tell us, Jim?
It's a great question, and we took a dive into some data, and according to Forbes magazine, from 1950 to 2013, the Dow Jones average did indeed underperform in those time periods. It had a return of 0.3% from May to October. Again, that's 1950 to 2013. And that contrasts with an average gain of 7.5% from the November to April time period. However, recent evidence shows that this seasonal pattern may not be the case. According to Investors Business Daily, the NASDAQ rose by 55% from the end of June through January 2018. That's June of 2016, I should say. So if you had sold in May of 2016, you missed the front end of that move, that 55% move that took place over the next 18 months. Looking at some specific sell-offs that occurred in the May to October spans of time, we find the stock market crash of 1929, highly unusual. The crash of 87, also unusual. The drop after 9/11, and then the September-October plunge associated with Lehman Brothers, Fannie Mae, and Freddie Mac in 2008. If you strip all those four time periods, the results of sell in May and go away are essentially a fraudster's tip. In fact, you could make an argument that those four time periods were good to be buying. Now, what about some recent evidence? We've talked way in the past. Some statistics that we can bring up. In 2017, the S&P index rose 6% from May to October. Going back to 2014, May to October stretch delivered a gain of 7%, and in 2013, that stretch of time delivered a gain of 10%. So clearly, if investors had sold in May and went away, they greatly diminished not only their short-term performance, but also their long-term performance. So when we look at the data, when we compare it with just what the media headline is this, I come away with a couple different things. Number one, it's not a pattern that you can conclusively trade on. Perhaps day traders want to give it a go. The last couple of weeks we've seen some volatility here in May, but it is not something that is statistically holding up over time. I think the other thing, and this is what we would take away long term, is if you are going to take action in May to October, come in and meet with the advisor, do some long-term planning. And if we have a downturn, if we have a significant sell-off, that represents a good time to add to your position. So sell in May and go away, maybe for day traders, but for long-term investors, don't sell in May. Come in, let's have a meeting, and let's build the portfolio. Okay, Tim, so to conclude our topic number 3, IPOs. We've had a couple of big name IPOs recently that have been widely anticipated. Some have risen, some have taken a step back. What are we to make of the volatility going forward?
Yeah, I think the big thing with the IPO market is that a lot of these companies are very difficult to evaluate, difficult to value, and a lot of investors have probably heard about price to earnings ratios. Well, in the case of in IPOs, there's not any earnings usually. The sales is strong, the sales growth is strong, but in a lot of these businesses, earnings do not exist. And in fact, you hear a lot of the media talk about cash burn. A lot of them have really poor cash flow as well, meaning in order to sustain their growth trajectory, they'll either need to issue more stock to raise money or take on a lot of debt. So I think if you're considering some of the IPOs that are coming to market in 2019, you should really do your due diligence and try and understand how the market may be valuing the business, have an understanding of just what their earnings potential could potentially look like, how likely they'll be profitable in the near future, and only allocate what you feel comfortable losing. Not to say that a lot of these larger IPO tech darling unicorns will likely to go bankrupt, but I think it's important to know that a lot of these exciting new companies are very difficult to price by us, the institutional investor, and they could lead to a lot of volatility as a result.
So stick with blocks and tackles maybe, and we'll have the specialty plays down the road.
Exactly.
Excellent. Well, Tim, thank you very much. We appreciate it. Thank you for joining us, and we look forward again to seeing you next month.